Hello, investor and trader. Welcome back to another episode. So, for the past 6 months, or a little bit more than 6 months, TTCF is very popular among YouTubers, either trading this or investing in this. Now, what I'm about to say is my honest opinion. Again, it's all my opinion from an investing standpoint and a trading standpoint because I do both. Um, Okay, so when it comes to investing, I have several criterias that I have to pass for me to buy this company. I'm going to share those criteria with you guys. And when it comes to trading, this stock is perfectly for trading. In fact, I did trade this in the past. I bought some here in the 17, 18s, and I sold in the low 20s. That was a pretty good gain, like over 20% gain, and I just sold it. But when it comes to investing, this stock does not fit my criteria. So you have to find out what fits your investment criteria. Can you stand this kind of volatility, right? I mean, whew, there's a lot of volatility. I mean, I would say majority of the investor probably buy it somewhere up here because this is when it get really excited for investors, right? But next thing it went down. So right now, most investors are underwater, especially this happened. So now let's just talk about the fundamental real quick. So let me pull up this earning report they just released from their website right here and the product. First of all, I haven't tried the products yet, but I did look at the product. I think they sell it at Target or something like that. For me personally, I think the product is kind of pricey in a way, maybe because I'm just cheap. Okay, so revenue has increased, so that's a good thing. From 67 million, or make it 68 million, to 103 million. Now that's like what 30% something increase in revenue, so that's pretty good. I like to see that when it comes to growth stock over 20 or 30%. Okay, gross profit. They could improve this a little bit better, all right? I mean, this increased by 30%, yet this hardly increased. So they have to work on this a little bit. Now right here, the operating expenses from 4.4 to 28.8. That's an increase over sixfold. Now, if they can bring this down, maybe they can turn this to a profit or something because this number right here, that's not good. That could probably be one reason why this stock dropped so much. Because in revenue wise, they just missed like several $1 million. I don't think the revenue that causes the drop of the stock. I think it could be this right here or this right here, especially. Look at this share dilution. This is not good. When it comes to investing, you don't want a company dilute the crap out of it. I mean, it went from 28 million all the way to 81 million. That's a lot. Now, if you go back here on Finvis to see some more data, sorry, I don't have the paid version, so you can't see more data. All you see is these numbers only. But you can clearly see that it went from 6.6. You know what? I have it here for the other years. Okay, so this is so I pull back all the earning report what they have offered from 2019 to 2020. You can see the share dilution, right? It went from 28 to 36 million shares. The previous year, 18 to 19, you can see right here, if I can find it. So they were 6 million. So they went from 6 to 28 to 36. And right now they're approaching 81. Well, that 81 already. As you can see, just a past couple years, from 6 million to 81 million, dude, that's more than tenfold. So this is like you own a share of this company, but you're getting at least less and less piece of the pie. As an investor, I don't want that. So let's just talk about the technical real quick. So from a technical standpoint, I can see that there's a trend right here. It's literally doing a wedge. So we are at the bottom of the wedge already. Right there. And one more. Right there. Something like that, right? This wedge right here. So if we go to our handy dandy Google, free information, no course involved, and just type in wedge pattern, you can see all this wedge, and it tells you how to play it out, right? Eventually, this wedge is going to break out. Eventually. We just don't know when. Well, let's go to the chart here again. If we extend this out like that, if maybe another quarter or two, it will break out either upside or to the downside. Now, if we use another indicator, which I don't really show here much, is the Bollinger Band. Just to give you this idea of we at the bottom or not. So on the daily, right, we are at the bottom of the Bollinger Band. However, now this is where the other time frame comes in, the weekly. So we are also at the bottom for the weekly, but notice this moving average right here. So I've been bouncing here and here, so now we are right on it. So this could be the bottom. I don't know, it could, but look at here, the stochastic is sloping down. Now, if you really want to go farther out to the monthly, yeah, this thing can definitely go down below 15 or 14, even down to 8 potential. I mean, it's going to take several months for that to happen, but just to give you an idea, you know. So let me just take this Bollinger Band out, delete, and let's go to the weekly. No, let's go to the daily since it drops today. So one thing I learned, now this is why it's so important to know some technical plus fundamental, especially you want to invest in this company. My number one rule, when a stock gap down like this, I do not like to buy on first day. I learned from my previous mistake. My first 5-figure loss was this type of play right here. When they miss earning, the stock dropped. It was Domino's Pizza. Let me show you guys real quick. I think I talked about this in my other videos, where I learned my lesson. This is happening in summer 2017. The stock went 200 all the way down to 190 something. The reason why I still remember it because, like I said, it was my first 5-figure loss. That time for me, 5-figure was a lot of money. I was a college student back then, so you can see where it scarred me to this day. So huge gap down in terms of the technical formation or technical standpoint. See dominoes right there? Miss earning, you see? Just huge gap down. And what does it do the next couple of days? It just continues to the downside. So the point I'm trying to say is, on a huge gap down, let it drop. Don't catch a falling knife. Because this is like a catching a falling knife, right? Let the candle finish just to see how low it go and what kind of candle it form. Obviously, it formed a solid red candle. And I mean, it tells me, okay, there'll be more seller because today volume is pretty damn high, over 11 million. I think it's the highest volume since months ago. So now what I need to do, and it was also Friday. So next week or the next couple weeks, I would wait just to see what kind of candle will form because the worst thing you want to do is just continue to the downside, right? And you're going long. That's not good. And you need to wait for that reversal signal. Just like how I mentioned my last video about wicks. Remember, huge gap down. I still haven't buy wicks yet. You see, I'm waiting for the reversal signal. I'm waiting for something like this. See, big red candle drop. Next candle. You see, that's why you don't jump in. Look at that. It's still going down. Aha! A little doji. A little good sign. It could be a reversal. A doji is indecisive. It doesn't know where to go yet, either up or down. So we need to wait for the next candle. See? Now, look. A bullish pin bar. A small one, but it's still green on pin bar. So the next candle, what I'm looking for is a higher high and a higher low. Ideally, I want to buy. Let me zoom in. Ideally, I want to buy at a higher price than this one. I think I talked about it in my last video, right? So you can see the price right here. The high is 225.74. Since it's a $200 stock, you give it a quarter. So 226. And sure enough, it hits. The reason why I don't want to buy a low because like this right here. If you, let's say right here, right? Let's say you think this is the bottom and you decide to buy this on the next day and you have your buy order up here. Well, guess what? You would save this headache because your order would not get triggered because you're buying a higher high. So that is why I haven't buy this stock yet. You can see it hasn't created a higher high yet. In fact, it created a lower low and a lower high. So therefore, it's still more to the downside. Same thing for TTCF. Now this is the technical standpoint, okay? So I would definitely wait, although it is at the channel over here at the wedge. Now for you are investing on this, I wouldn't buy it here either because investing, you want to buy the best price as you could to maximize your profits, right? So it is important or somewhat important to know some technical also. Okay, so this is the list of the criteria that I would invest in a company, and it has to fit this criteria for me to buy this stock or buy heavily into it. So, step one, growing more than 10. Ideally, I like more than 10%. Consistent growth in revenue, income, and cash flow from operation. TTCF failed that already because they don't have cash flow in operation yet. In fact, they are negative. You can see it right here from Google source, which is another source that I use. See, negative so far. In fact, you need more data, but you get the idea, right? Consistent, okay? That's the key word. Consistent growth and income and cash flow from operation. Regardless of economic cycle, regardless if we are in a recession or not, I still want to see consistent revenue. And there are only a few stocks that fit this criteria. I'll show you the stock in a little bit. Secondly, low PE ratio, prefer under 25. A lot of tech stock are like in the 30s and 40s. That's fine, but ideally I like a low PE ratio. Since this stock is not making a profit, when you look at the price to sales, ideally I want it under 10 or 5. The lower the better. The higher, I'm kind of concerned. Obviously, Tech2 Chef PS ratio is very high, right? Well, not really. Never mind. It's 6. Okay, but then it failed all the criteria already, so therefore I'm not going to invest in this company. Another the one I look at is assets or reliability. That's checked out already for Tech2 Chef. Wide economic moat, also a monopoly brand, and a high cost to entry. Tattoo Chef failed that already. It's not a monopoly brand. In fact, it's still a growing company. It's just barely IPO in a way. Conservative debt. I think Tattoo Chef can pass that. Huge, strong cash position. That means they have a lot of cash in the balance sheet. So that way, if hard time comes, the company can survive. So Tattoo Chef, I think it passed that already. High and consistent return on equity, known as ROE. Sorry, they don't have that yet because it's still yeah. So that's another criteria. Remember, I had to fit all these criteria, not just one of them missing. I kind of question share dilution. I just mentioned about that. I don't like it when a company keep issuing shares. And you notice a lot of penny stocks. Well, you trade penny stocks. You notice that in the middle of the day, the stock going up, right? It looks good, $4 or $5, go to $6, $7. Next thing you know, company issue share. That thing just tanked like 50, 80%. That's what happens. But just these kind of stock, you don't see it. It's like a silent killer. You own in less and less share of the company without even noticing it until you look into it. Uptrend on a 10-year. Now notice I said 10-year, okay? Obviously, Tattoo Chef don't have that kind of record, so I failed that criteria already. So the question is when to buy. Temporary bad news. Either correction, stock market crash, miss earning, and it has to land on key level support, preferred below or near the 200 moving average. The reason I say that is because the lower the better, right? So let me give you an example of what stock that is. You can pause the video and see the list if you like. One example I can give you guys is Adobe. Adobe fits all the criteria that I just mentioned right there. And it's really rare. These stocks, maybe like 1 or 2% of the entire stock market. So even a 10-year-old can see this, right? Revenue is increasing every single year for the past 10 years or more. Net income also increase. Now this right here is what I look for. See the cash operation right here? Cash flow, net income has to be consistently increasing year over year, and it does that. That's good. Debt to cash, it does that too. It's pretty good, although they have kind of high debt now, but then that's fine. I'm okay with that. Now if we go to here, see, 42%. That's very, very high. So right now is the time to buy Adobe? Heck no. First of all, PE is way too high. Remember, it says right here, right? Or I wrote right here. You only buy these happens. So when this happened right here, just let it run. Eventually it go back. Nothing to worry about. Another example I can give you guys is United Health. So let's go here. Yeah, I know these are pretty boring company, but guess what? That's why I don't really lose when it comes to investments. I only win, and I sleep well at night. Oh, what the heck? Sorry, I thought it was UNH. Dang, it's laggy right now. See, consistent income, revenue is the same thing. It is a brand monopoly after all. I pay a little bit of dividend, but it's okay. Now this right here doesn't really concern me as much. Like I said, as long as it's reasonable debt to cash ratio. So if we go to here, 21% is pretty good. PE is 27, which is kind of high. Price to sell only 1. But you get the idea, right? On top of that, check this out. This is where I look at too. See, the share dilution is decreasing. That's good. That means the company is buying back shares. That is good. This right here, it don't really concern me as much. CEO just taking the profit. Like I said, when a stock goes like this, I'll take my profits too. Especially keep going up like this. You want to buy when the stock goes down, not up. You want to take profit when the stock goes up, either for investing or swing trading or day trading, or whatever you want to call it. Another company that I can give you guys is Facebook. See? They're all the same, right? All going up. You can do this, later on you can, pause the video or something like that to see more what I'm looking for when it comes to long-term investments. That's why you can't lose in these companies. You can't lose. There's no way. Tattoo Chef, that's questionable. See, look at that. 30%. PE is getting kind of high, right? Check out the share buyback. Or are they diluting shares? Yeah, look consistent to me. At least they're not diluting shares, so that's good. But you guys got the idea, right? So, in general, to wrap up, when it comes to investing in these kind of stock, you need to have a lot of risk tolerance and don't go big on this position. Um, like I said, it's all about risk management. If you can handle this kind of volatility, load up right here. Cause I know some YouTubers have been loaded up right here. As for me, I would not load up right here because, like again, technical formation, I need to see the reversal signal for me to maximize my profit. As you can see, the stochastic RSI is still sloping down. Go to the 1 week. This thing is definitely sloping down. It has not even curved back up yet. So therefore, I would not buy this stock for investing yet. I would wait for another couple of weeks for let it cool down, let investor digest what's going on with the company. Then I'll slowly average my costs in for long-term investment. That is what I would do. Now, like I said, I don't this. Like I said, I show you my list, right? This stock for me, okay, personally for me, it failed the criteria already. So therefore, I will never buy this stock for long-term investment. I will swing trade and day trade this stock. Okay, see you guys in the next video, and good luck on your investments on TTCF.